I want you to picture two people, both roughly the same age, both careful, both the kind of person who reads the news, double-checks things, and would never wire money to a stranger promising a lottery prize. Both of them get the exact same phone call one Tuesday afternoon, someone claiming to be their bank's fraud department, warning about a suspicious $6,000 transaction and asking them to move their own money to a protected account to keep it safe. Both of them, for a few minutes, actually believe it, the same way any of us might on the wrong day, at the wrong hour, distracted by something else entirely happening in the house. Here's where the story splits. One of them loses $6,000. The other loses nothing. Not a partial loss to soften the blow. Nothing. Same phone call. Same scammer. Same script, word for word, down to the pauses and the reassuring tone of voice. The only difference between them was a decision made months earlier that neither of them thought of as a security decision at all. And I'd guess most of you watching this have never thought of it that way either. I'm Henry Collins. Every week on this channel, I walk through the specific scripts and mechanisms scammers use against people over 50. The exact sentences, the exact fake urgency, the exact costume worn by whichever institution they're impersonating that week. Today I want to do something a little different, because I think there's a single mistake sitting underneath almost every single scam I've ever covered on this channel. One that has nothing to do with recognizing a scam script at all, and everything to do with a decision most people made years ago without ever thinking of it as a decision. Here's the myth I want to take apart first, because I think it's the belief doing the most damage, quietly, to people who genuinely believe they're already protected. The myth goes like this. I'm careful. I read the warning signs. I know the ears doesn't call demanding gift cards. I know my bank doesn't ask for a code over the phone. I know Medicare doesn't charge a fee to enroll me. I've watched the videos. I'd never fall for it. I believe you. I genuinely do. Most of the people watching this channel are exactly the kind of person who catches 99 calls out of 100 without a second thought, hanging up the moment something feels even slightly off. But here's the uncomfortable truth sitting underneath that confidence. Recognizing a scam script requires you to catch it every single time, in the moment, under pressure, on a bad day, when you're tired, when you're distracted, when the call catches you between errands, when the voice on the other end is unusually good at their job, or when the day itself has already worn you down before the phone even rings. Scammers get to try as many times as they want, refining their script a little more with each attempt, discarding whatever didn't work and keeping whatever did. You only have to have one bad day, one moment of genuine distraction or genuine fear, for the script to work on you exactly once. Vigilance is a wonderful first line of defense. It is also, by its nature, a line of defense that occasionally fails, because it depends on a human being staying alert every single time, forever, without exception. Nobody manages that indefinitely. Nobody, no matter how sharp, how experienced, or how many of these videos they've watched. So here's the question I actually want you to sit with today, because I think it matters more than which scam script you're able to recognize. If vigilance fails you exactly once, what happens next? For most people, the honest answer is everything. Every account they own, sitting there, fully connected, fully accessible, through the exact same login, the exact same debit card, the exact same instant transfer app, all reachable the instant a scammer talks their way past that one moment of distraction. That's the mistake, not a lapse in judgment during a phone call. The architecture sitting underneath the phone call, built years before the call ever happened, that determines whether one bad 10 minutes costs nothing at all or $40,000. Let me explain exactly what I mean, because this isn't abstract, and it isn't complicated once you see it laid out. Most people, over years of banking with the same institution, end up with what amounts to one central checking account. Their paycheck or their Social Security deposit lands there. Their mortgage or rent comes out of there. Their bills get paid from there. Their debit card is linked to it. Their Zelle or peer-to-peer transfers run through it. Their entire financial life, every dollar they have quick, immediate access to, sits in a single pool, accessible through a single login, a single card number, a single app. It's convenient. It's simple. It's also, from a scammer's perspective, exactly one door standing between them and everything you have. I don't think this happened to most people through any conscious decision, and I want to be clear about that, because it's worth understanding how this arrangement actually came to be. Banks genuinely benefit when your entire financial life sits in one place with them, since it's easier for them to manage, easier for them to cross-sell you additional products, and easier for them to keep you as a lifelong customer who never has a reason to look elsewhere. None of that is sinister on its own. It's simply the natural direction things drift toward when nobody actively decides otherwise, the same way clutter accumulates in a garage without anyone ever deciding to let it happen. A single consolidated account isn't a mistake anyone chooses on purpose. It's the default outcome of never actively choosing anything else, which is exactly why almost nobody thinks of it as a decision at all, let alone a security decision. Now here's the part that connects directly back to nearly every scam I've ever broken down on this channel. Whether the script is a fake ears agent, a fake bank fraud department, a fake Medicare enrollment specialist, or a stranger asking you to Zelle back an accidental overpayment, every single one of those scripts is aimed at the exact same target, convincing you to move money right now through whatever access point connects most directly to your full account. If that access point only touches a small slice of your money, the absolute worst outcome of a successful scam call is limited to that slice. If that access point touches everything you own, the worst outcome is everything you own. The scam script barely changes from one version to the next. What changes dramatically is how much damage a successful script can actually do, and that's determined entirely by a decision that has nothing to do with recognizing scam language at all. I also want to walk through something most people have never had explained to them clearly, because it changes how you should think about which legal protections you can actually count on. There's a federal rule called Regulation E that limits how much you can lose if someone gains unauthorized access to your account, say, by stealing your debit card or hacking your login without your knowledge. Report it within 2 business days, and your liability caps out at $50, no matter how much a thief managed to take before you noticed. Report it within 60 days of your statement, and the cap rises to $500. That's a real, meaningful protection, and it's worth knowing about, worth genuinely relying on if your card is ever physically lost or stolen, or if someone breaks into your account without your knowledge at all. But here's the gap almost nobody understands until it's too late, and it's the single most important distinction in this entire video. Regulation E protects you against transfers made without your knowledge or consent. It does not reliably cover a transfer you made yourself, with your own hands on your own phone, because someone convinced you to make it. The regulation draws a hard legal line between unauthorized and authorized but deceived, and every scam I've covered on this channel falls on the wrong side of that line. The fake fraud department asking you to move money to protect it. The stranger asking for a refund on an accidental overpayment. The fake enrollment fee. The fake ears threat. All of them involve you personally authorizing the transaction. You were deceived, thoroughly and cruelly, but you still pressed send yourself, and the law was never built to reverse that particular kind of harm. Some banks now voluntarily reimburse certain impersonation cases, and that's genuinely good news where it applies, a real shift from just a few years ago. But it's a policy choice by individual banks, not a federal guarantee, and it's decided case by case, after the fact, once the money's already gone. It's not something you should be building your actual line of defense around. The real defense has to happen before the call ever comes in and how your money is actually structured, because by the time you're on the phone being deceived, the legal protections that would have saved you have already mostly stopped applying. Let me give you a specific, honest example of how this plays out, because I think it's more useful than a hypothetical. A retired teacher named Diane, 63, had banked at the same credit union for over 20 years. One account, everything running through it. Direct deposit, bills, her debit card, her Zelle. She'd never had a reason to think about it any differently. It was the account her late husband had opened when they first moved into their house together, the account her children's college savings had passed through decades earlier, the account that felt, after 20 years, less like a financial product and more like a permanent fixture of her life. The way a kitchen table becomes part of a house. When a caller impersonating her credit union's fraud department told her there'd been a suspicious $11,000 attempted withdrawal from an unfamiliar device, Diane felt the particular jolt of fear that comes with hearing a specific dollar figure attached to your own name. The caller was patient, unhurried, and used the exact right vocabulary, mentioning her credit union by its full legal name, referencing a temporary hold and a verification transfer in language that sounded exactly like something a real financial institution would say. Over about 8 minutes, calm and reassuring the whole way through. He walked her step by step through moving her funds into what he described as a secured holding account, explaining that this was standard procedure while the suspicious device was blocked from the system. There was nothing standing between that 8-minute phone call and the entirety of what she had, because everything she had lived in the one account he was walking her through emptying. She moved just over $11,000 before her daughter, arriving for an unrelated visit 20 minutes later. Noticed she was shaken, sitting at the kitchen table with the phone still warm in her hand, and asked what had happened. By then it was done. Diane's caution, her intelligence, her decades of careful financial habits, none of that was the failure. She'd raised 3 children on a teacher's salary, managed a household budget for 40 years, and never once fallen for anything remotely like this before that Tuesday afternoon. The failure was structural, not personal. One account held everything, and one successful 10-minute call was enough to reach all of it, because nothing about the way her money was arranged gave that call anywhere else to stop. Compare that to a version of the same story where Diane ran her checking account differently, the one linked to Zelle and her debit card, keeping it swept down close to zero between bills, rather than sitting there as a standing pool of cash. Money would move in only a day or two before something was actually due. Rent, a utility bill, a card payment, and get swept back down toward empty again once it cleared, with the real bulk of her savings sitting untouched in a separate account at a different institution entirely. One with no debit card, no Zelle connection, and a transfer delay of a day or two built in before money could move out of it at all. The same 8-minute call happens. The same convincing voice, the same fake urgency, the same specific dollar figure designed to trigger the same jolt of fear. But now there's nothing sitting in that checking account for the call to reach at all, because on an ordinary Tuesday between bills, the account simply holds close to nothing by design. The scam script didn't get any less convincing in that version. Diane wasn't any smarter or any more suspicious. The call ends the exact same way, with her fully convinced and fully willing to move whatever the caller asked her to move. There's just nothing there to move. The blast radius, and only the blast radius, changed, and in this version it shrank down to 0. I want to be precise about why this works, because I don't want to overstate it into something it isn't. This isn't a guarantee that a linked account always holds nothing. If the call happens to land the day after Diane funded that account to cover rent, there'd be a few $100s sitting there briefly, and that's genuinely the most a call on that particular day could reach. But compare that occasional, capped, worst-case number, a few $100s a handful of days a month, against the alternative, where the entire balance of a life savings sits exposed to the exact same phone call every single day for years, without exception. One version has a small, bounded window of real exposure. The other has no window at all, just a permanently open door. I want to be honest about something here, because I don't want this to sound like a magic fix that erases risk entirely. Splitting your money across accounts doesn't make you scam-proof, and it doesn't mean you should stop paying attention to the actual warning signs I cover every week on this channel. A determined, patient scammer working you over multiple calls, sometimes across several days. Building trust gradually before ever asking for money can still eventually talk someone into moving money out of a second account too, given enough time and enough persistence. This isn't a force field. But here's what this structural change genuinely does accomplish, and it's not nothing. It converts a single catastrophic mistake into a small, recoverable one. It buys you time, literally, in the form of transfer delays between institutions. Time during which a phone call with a family member, a pause to think, or simply a night's sleep can interrupt a scam before the money is actually gone. And it means that the single worst moment of distraction in your entire retirement costs you close to nothing instead of your savings. Here's what I'd actually suggest doing, in plain terms, without turning this into a complicated project that takes weeks to set up. Keep one account, the one connected to your debit card and any instant transfer app like Zelle, running as close to empty as you comfortably can between bills, rather than sitting there full as a standing pool of cash. Fund it a day or two before something's actually due, rent, a card payment, a utility bill, and let it settle back down towards zero once that payment clears. Everything else, the real bulk of what you've saved, belongs somewhere that doesn't have same-day reach, ideally at a separate bank or credit union entirely, so that a compromised login at one institution doesn't hand a scammer a direct path into the other. This isn't about distrust of any particular bank. It's about making sure that whatever happens to one login, one card number, one moment of distraction, physically cannot reach the rest, and that most days of the month, there's simply nothing sitting there worth reaching at all. Many savings accounts and money market accounts already come with a built-in transfer delay of a day or more between initiating a transfer and the money actually leaving. And that delay, the thing that used to feel like a mild inconvenience on an ordinary Tuesday when you needed money faster than the bank was willing to move it, is quietly one of the best pieces of scam protection available to you, completely free, requiring no technology, no subscription, and no vigilance in the moment at all. It works exactly the same whether you're sharp and rested or exhausted and distracted, which is precisely the point. A defense that only works when you're at your best isn't really a defense at all. It's a hope. The account structure I'm describing works on your worst day just as reliably as it works on your best one. And your worst day is exactly the day a scammer is counting on. I also want to say something about how this conversation tends to go inside families, because I think it matters, and because I've heard from enough of you over the years to know it comes up often. A lot of people hear this kind of suggestion and feel a flicker of defensiveness, as if splitting accounts is an admission that they're not sharp enough to spot a scam, or worse, a hint from an adult child that they can no longer be trusted with their own finances. I want to push back on that directly, because I don't think that's what this is at all. This isn't about your intelligence, and it was never about Diane's intelligence either. Every single person on this earth has one bad 10 minutes in them somewhere, a moment of distraction, grief, illness, or simple bad timing when their guard genuinely drops, regardless of age, regardless of sharpness, regardless of how many of these videos they've watched. Building your finances so that one bad 10 minutes can't reach everything you own isn't an insult to your judgment. It's simply refusing to bet your entire retirement on a single moment of vigilance never failing, not once, for the rest of your life. If anything, it's the more sophisticated position to take, the one that assumes real financial planning accounts for human moments of weakness rather than pretending they'll never happen to you. Comment down below and tell me honestly, how many of your active accounts, checking, savings, everything, are actually sitting at the same single bank right now, reachable through the same login, the same debit card, the same app? I think a lot of you are going to realize, typing that answer out, that the number is smaller than it should be, and that this is worth an actual conversation with your bank this week, not just a thought you have and then forget by dinner time once the video ends and the rest of your day takes over. I want to leave you with something a little different than my usual close, because I think it reframes everything else I talk about on this channel. Every video I make walks through a specific script, a specific sentence, a specific costume a scammer wears to sound official. Those videos matter, and I'll keep making them, because recognizing the script in the moment genuinely does stop most attempts cold, and it always will. But recognition is a skill you have to execute perfectly every time for the rest of your life, and I don't think that's a fair thing to ask of anyone, no matter how sharp they are, no matter how many warning signs they've memorized. The account structure I've described today isn't a skill you have to perform under pressure. It's a decision you make once, calmly, on an ordinary Tuesday when nobody is calling you at all, sitting at your own kitchen table with nothing more urgent to do than open a second account and move some money into it. And it quietly does its job on the one day, years from now, when your guard happens to be down and nobody's vigilance, not yours, not mine, not anyone's, would have been enough on its own. I think about Diane sometimes and about how she describes that Tuesday now years later. She doesn't talk about it as the day she was fooled. She talks about it as the day she learned that a lifetime of good judgment can share a room with one bad 10 minutes, and that the two things aren't actually in contradiction with each other the way she used to assume they were. She's rebuilt what she lost, slowly, and the first thing she did afterward, before anything else, was open a second account at a different institution entirely, one with no card attached to it at all, just a login and a transfer delay standing between her savings and any phone call that might ever come again. She told me once that it was the least dramatic thing she'd ever done for her own protection. No alarm system, no new locks, nothing to point to and feel proud of, and also, in her own words, the single most useful thing she's done since the day it happened. If there's one thing I'd ask you to do after watching this video, it's not to memorize another warning sign. It's to look at your own accounts today, honestly, and ask yourself how much of what you have is sitting behind that one login, that one card, that one app, reachable in a single conversation with the wrong person on the other end of the phone. If the answer is more than you'd want to lose on your worst possible day, that's worth a phone call to your bank this week. Not someday, not eventually. This week, while nobody is calling you at all, and the decision is entirely yours to make on your own terms. I'm Henry Collins. Thank you for listening.